view has been that the bulk of the inflation that we are seeing comes down to the negative supply shock. And it's not isolated to the United States, but it's a global issue. And that slow growth, high inflation regime, stagflationary dynamics, has made its way to APAC, and it's typically very negative for risk assets. But what we've seen as a result is quite consistent with that. Foreign investor outflows have been notable in the first quarter, and that is understandable given the region is primarily a net food, materials and energy importer, all those goods that are going up in price. And the APAC region is particularly vulnerable to reduced supply of those goods. Sounds pretty bad, but we have stressed time and again that the region isn't monolithic. The impact across the region is expected to be quite uneven, and what we have advocated is a more thoughtful approach to portfolio construction. So investors should seek shelter from that negative growth shock, weaker growth, by focusing on economies that are net food and energy exporters, those that are less reliant on the kindness of strangers for capital, those economies that still have policy space to support growth. At the same time, it's worth seeking shelter from the negative supply shock, higher inflation, by seeking out those economies with relatively lower weights for food and energy in their CPI baskets, lower share of food and energy in their import baskets. So when we balance the simultaneous impact from those two shocks, our analysis has suggested that within Asia Pacific, the likes of New Zealand, Malaysia, Indonesia, Australia, Vietnam to a degree, these will likely be the relative macro outperformers among the economies that we follow. When we look at the relative performance in equity and fixed income space since the war broke out in February 22, the performance of those asset markets are relatively consistent with that thesis as well.